The 2026 crash won't announce itself with sirens. It'll start on a Tuesday morning when Nvidia misses earnings by 2%. The stock drops 15% in pre-market. No big deal, right? Except Nvidia makes up 7% of the entire S&P 500. When it falls, it drags the index down with it. Tech investors panic. The selling spreads to Microsoft, Apple, Amazon. Within hours, the Mag 7 stocks that represent over a third of the S&P's value are bleeding red. Your diversified index fund? It just lost 8% before lunch. Here's where it gets ugly. Passive investing means money flows automatically. When prices drop, algorithms trigger sell orders. ETFs that hold these stocks start liquidating positions to meet redemptions. This creates more selling pressure, which triggers more algorithms, which causes more panic. It's a cascading failure, like dominoes made of dynamite. By day 3, the real contagion starts. Remember that $4.5 trillion in corporate debt maturing between 2025 and 2027? Companies borrowed at 2% interest rates. Now they need to refinance at 6 to 7%. Imagine your mortgage payment tripling overnight. That's what happens to corporate America. Suddenly, companies that looked healthy on paper can't service their debt. Bond markets freeze. Credit spreads explode. Your 401k is down 20% in a week. But you're not worried yet because the news says it's just a correction. This is where the psychology gets dangerous. In 1929, only 3% of Americans owned stocks. Today, 58% do. Your retirement, your pension, your kids' college fund, all tied to the same system that's currently imploding. There's no escape hatch this time. Week 2 brings the real pain. Baby boomers are retiring at $10,000 per day. They're not buying the dip. They're selling to fund retirement. They have to. Social Security doesn't cover the mortgage. This selling pressure doesn't stop. It's structural. It's demographic. It's unavoidable. The market tries to rally on Tuesday. False hope. By Friday, it's down another 12%. Now the derivatives market wakes up. Remember, there's $600 trillion in notional value floating around in bets on bets on bets. When volatility spikes, margin calls go out. Hedge funds that were leveraged 10 to 1 suddenly need cash immediately. They start dumping everything: stocks, bonds, gold, crypto. Liquidity evaporates. The bid-ask spread on major stocks widens to levels not seen since 2008. You can't even sell at fair prices anymore. By month 2, pension funds are in crisis mode. State pensions assumed 7% annual returns forever. They're down 35% and massively underfunded. Illinois, California, New York, they start announcing benefit cuts. Public sector workers realize their guaranteed retirement just became a maybe. Consumer confidence collapses. People stop spending. Businesses see revenue fall. Layoffs begin. The Fed tries to help. They cut rates to 0. They restart quantitative easing. They buy corporate bonds. But here's the problem: you can't fix a solvency crisis with liquidity. Companies aren't failing because they can't access cheap money. They're failing because nobody wants their products anymore. The Fed is trying to put out a structure fire with a water pistol. Month 3, the real estate market cracks. Mortgage rates spiked earlier in the year when the Fed was still fighting inflation. Now, with unemployment rising and stocks cratering, people can't afford homes at these rates. Prices start falling. Not gradually, violently. Homeowners who bought in 2024 and 2025 are suddenly underwater. They owe more than the house is worth. Strategic defaults begin. The 2008 playbook repeats, but faster. Banks start looking shaky. Not because they made subprime loans this time, but because they're holding commercial real estate debt that's worthless. Office buildings sit empty. Retail spaces are ghost towns. The regional banking crisis of 2023 was a preview. This is the main event. The FDIC steps in to guarantee deposits, but trust is gone. People start pulling cash. Not everyone, just enough to cause problems. By month 6, the psychological damage is complete. An entire generation watched 2008 wipe out their parents. Now they're watching their own savings disappear. But this time, there's no recovery narrative. There's no housing market to prop up. The tech boom that powered the 2010s is revealed as a mirage. AI didn't reshape the economy. It just inflated valuations. The scariest part? The government can't save us this time. Federal debt is already at 350% of GDP when you include all liabilities. The interest payments alone exceed defense spending. There's no fiscal capacity left for a massive bailout. They'll try to print money, but that risks hyperinflation. They're stuck between a recession and a currency crisis. Here's what's different from 1929. Back then, wealth destruction was simple. Stocks crashed. Banks failed. Done. In 2026, the damage is systemic. Your retirement account evaporates. Your home value collapses. Your currency devalues. Your pension fund implodes. And the social safety net breaks because the government funding it is already insolvent. The 2026 crash doesn't destroy wealth. It destroys the belief that paper assets have value. When people lose faith in the system itself, that's when things turn medieval. Money only works because we all agree it works. Break that agreement, and you're not just poor, you're in a different game entirely. This isn't fear-mongering. When you build an economy on $600 trillion in derivatives, when you leverage everything 6 times over, when you make the entire middle class involuntary day traders, you create systemic fragility. All it takes is one domino, one earnings miss, one margin call, one crack in confidence. The 2026 crash would look like 1929, 2008, and something entirely new all at once. Faster, deeper, and with no way out. Because this time, we're all in the market. There's nowhere to hide.